Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Mike D'Ambrosio, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate and much, much more. And now, to guide you around the world of real estate, here's your host, Mike D'Ambrosio.
Welcome to the new podcast. This is Mike D'Ambrosio and Laura Pesavento with the D'Ambrosio Real Estate team. How you doing, Laura?
Hey there, I'm awesome.
This is the Real Estate Radio Live podcast. This is the first time we're doing just a straight podcast, and we've been podcasting for quite some time now with the radio, but it's basically our live shows repurposed into podcast. So now we get
We're just going straight
podcast.
The middleman.
It's going to be the same great information, education, all of that good stuff. We're super excited about it. Make sure you share this podcast with your friends, family, coworkers, and also, if you have time, please go give us a review on iTunes or even our website. And our website is reradiolive.com. That's reradiolive.com. And again, you can download our podcast on iTunes, Stitcher, or just simply go to our website, reradiolive.com. If you want to text in any questions, comments, or have any, you want to know about future shows, you can reach out at 408-630-0101, 408-630-0101. And you can also email me, Mike at reradiolive.com. That's Mike at reradiolive.com. And again, don't forget that you can consider me as your trusted advisor for anything real estate. So feel free to reach out. You can go to my website, MikeDsells.com. That's MikeDsells.com. I think I got it all in there, did I?
Oh, text too.
Right,
just
you can text in, yeah.
A big text move right
All right. So again, today's our first day on the podcast. We're going to be talking about some trends that we want to watch in 2017. We got a couple other things we're going to get to as well, but I really want to focus in on things we're looking for in 2017. And I'm also going to be doing a show with Joe on Tuesdays, and you guys will hear that tomorrow. But so basically the way the schedule for the podcast are going to work out is I'll be doing the Monday show, and sometimes Laura with the D'Ambrosio team is going to be on the show with me as my trusty sidekick. And then other times we're going to have some guests. So we'll typically have on
lots of partners.
Our partners, we have anywhere from Joe's one of our partners, obviously, with financing, but, escrow, title, 1031 exchange, inspections, termite,
services, all
contractors, attorneys. And then we like to get people from outside of the state, too, that, involved in the Wall Street Journal or Keeping Current Matters or any other, anything real estate related, we are totally into, and we want to give you guys that information. And again, if you guys ever have anything you're interested in us talking about, please feel free to reach out, and we're happy to get that for you as well.
Or if you wanted to become one of our partners and wanted to be a special guest, give us a ring.
Absolutely. So, okay, how's everything going?
Awesome.
Good. This is kind of different being in here, isn't it? But
I love
good.
it.
It's low key. I like it, and I know we're getting a lot of traction on the podcast, a lot of great feedback, and we appreciate you guys that are listening in. So let's get to what we're going to talk about today. I know probably the big thing that's weighing in on everyone's mind is the election and what that's going to mean.
Dun dun dun.
Yeah, what that's going to mean to the real estate market. I'm going to talk about it on the show with Joe tomorrow as well. We'll probably touch on it briefly, especially what that means for the stock market and real estate prices and all that good stuff. But so I'm not going to make this a political show. So we're not going to talk about who should have won.
You don't want to get in a fight?
No, I don't want to get in a
Mike,
fight.
This is what you and I do best.
I don't want people to reach out and talk about...
And send you hate mail?
Yeah, send me hate mail. But, the bottom line is that there's going to be some changes, I'm sure. And so one of the things I see now that obviously is, unless you've been living under a rock the last couple of weeks.
And that's a possibility.
Donald Trump won. And whether you like it or not, we're not going to get into that. But
we're going to make real estate great again?
Yeah, we're going to. There you go.
Oh,
I like that.
I knew that was going to be coming. I thought I'd just beat you to the punch.
So I think that his presidency is going to be pretty good for housing and mortgages.
Because?
Especially in the sense that on the mortgage side, and we're going to talk about this with Joe tomorrow. Really, the mortgage industry is highly regulated, is heavy regulations, probably one of the most in the entire, in any industry other than financial services. But I think that he is all about, lessening government control, government standards. So I think that if he does that with the mortgage industry, it's going to, could make credit more available, make it more fluid. It'll make it easier for the average home buyer, that may have already been locked out of today's extraordinarily tight credit standards. So I think that in that sense, it could be good.
So the criteria, you think will be a little bit looser than if
I
Clinton
think so.
were to be?
I think so. I think with Clinton, you would have had the same old, just regulated government involvement. Which again, I'm not going one way or another, but I just think that based on their history, that's probably the way it would have gone. So, also, I think that with Trump becoming president, what was I even going to say?
You were talking about the difference and why you think it's going to be better.
Oh, I think that with Trump, so the other thing is with taxes, right? So Trump's big thing on taxes is that he obviously wants to lessen taxes on the middle class or people with wealth. I think especially when you have people that are not selling in certain areas because they have to pay such a high tax, like for example, if they're in California, if they're a married couple, and they have over a $500,000 gain, you have the capital gains, right? So, or if you're individual, you have $250,000. I don't know if he's going to make changes with that. It's going to be interesting to see if he makes any change in the tax code, but if it does, it's going to be beneficial. In my opinion, I'm assuming it's going to be beneficial, and therefore, it might let homeowners be able to sell if they're not going to be paying as many taxes. So some of the people that were on the fence because they didn't want to pay so many taxes might now be incentivized to sell.
Is that even a word, incentivized?
Yeah, it is.
Okay.
If it isn't, reach out, Mike at reradiolive.com. If you're an English teacher, you can reach out.
Yeah, but okay, that makes more sense. Are you trying to say that maybe like it's going to make for a hardier market then? So because there's going to be a lot more activity.
Well, again, I think it's going to be it's going to get more normal. Again, just this year has been the year of normalcy. I think it's gotten a little bit more normal. And for all of you that listen to the podcast, I want you to realize that we do podcasts in Silicon Valley. I do sell real estate full-time in Silicon Valley. So we live in a little bit different of a world, a little bit different of a culture here than most of the country. So when I talk about normalcy, we've seen craziness the last 3 or 4 years.
It's the new normal.
And it's getting a little bit more normal than it has been in years past. So I think that's going to continue into 2017. And getting back to your original question, if we do see more inventory because maybe the tax code changes or it's taxes are less burdensome, then we will see more inventory, which means it'll be a healthier market, essentially, which is good. I think it's good for that.
Yeah.
So that's why I see that happening. What do you think?
And when do you think that's going to happen? I mean, when would you? I mean, I know you don't have a crystal ball.
Yeah.
But okay, so he takes office technically in January.
Yeah.
And so what's up? When do you
who knows
think?
how long it's going to take him to?
I mean, if that were to be shaking down like that, I mean, when would you kind of suspect that might be happening? That we have a healthier market?
I don't know.
Maybe
I think
second quarter?
No, I don't even know if it'll happen that quickly. Maybe near the end of the year. I'm not sure. It's really going to be interesting to see how much he gets done in a short amount of time, which has been his whole promise. Is, if you've read any of the articles about his first 100 days, he's promising some pretty big things.
Yeah, I'm not reading that because I don't want to, expect something and have it not happen. I'll just kind of watch it.
It'll be interesting to see what happens. Let's just say that. And I don't know. I don't think with as much government and bureaucracy as there is already, I don't think anything can happen within the first couple quarters. But I think you'll start seeing some changes.
I do think that people are going to start looking for that stuff. But, since we're talking about looking for that kind of stuff in the first quarter or, people kind of anticipating, we normally anticipate some historical activity around the Super Bowl, right?
Yeah,
Mike?
so thank you for bringing that up. That's one of the things we wanted to talk about today, and we'll get more into some of the other trends probably on the other side of the break. But really, as we're sitting here today, it's early December, and so things are really going to start slowing down over the coming weeks. I think give it another couple weeks. We'll see properties coming on the market. But honestly, once you hit like December 20th, it's like going into a real estate office between the 20th of December to like after January. It's like a morgue in there.
You can hear crickets.
It is, and it's just a fact of life. It's not because and things are still happening, sales are still happening.
Well, the real, true, serious buyers are happening.
Yeah,
right?
that is, but it's a really slow time. So really, the big indicators in the real estate market are typically Super Bowl weekend, which is usually the first weekend of February. So after that, we start to see inventory come back on the market because really, in my opinion, and a lot of other people's, is that the Super Bowl kind of is the end of the holiday season, essentially. I guess you'd call it.
Oh, wow. That's pretty bold. Yeah.
Is it not? I mean, everyone does something for Super Bowl. Over 100 million people watch it, right? So
sure, Mike. Let's just put it all in with Christmas.
Well, you start. So the holiday season starts obviously with Thanksgiving.
Yes. Yes. Oh, I.
And then you have Thanksgiving,
I
and then you
understand what
have
you're saying.
Christmas Eve, Christmas, New Year's Eve,
Yes.
New Year's, and then Super Bowl.
A month
so
later.
really, it's almost like a 2-month span, a little bit less than that. That's pretty slow.
Yeah. Yeah.
So usually you see a peak in inventory after that, and then also you're going to see it after Tax Day, which is April 15th. For those of you guys that haven't paid your taxes for a couple of years or something like that and forgot what Tax Day is, it's April 15th. And
the day before Easter.
Yeah. So
wow.
Is that the day before Easter?
It is. This year it
wow.
is. You got to, yeah.
So I should know that actually as a Catholic.
You really, well, you just outed yourself.
Well,
but
whatever. I'm not preaching anything on here.
Back to the Super Bowl thing. Yeah, I understand what you're saying.
Yeah, so those are usually the big benchmarks, and then really it's been a strong market from March, April, May, June, July, August. Really, are going to be your peak months. So it's just
looking forward to it.
It's going to be fun.
Yeah,
it's always a fun time.
Activity time.
So, anyways, we got to take a quick break. Again, if you got any time, give us a review on iTunes, or you can go to our website, reradiolive.com. That's reradiolive.com. It's the D'Ambrosio Real Estate team here on the Real Estate Radio Live podcast. We appreciate all you guys tuning in. Stick around. We'll be right back on the other side of the break.
For more information on today's program, visit reradiolive.com. That's reradiolive.com. Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit reradiolive.com. That's reradiolive.com. Again, your host for today's edition of Real Estate Radio Live, Mike D'Ambrosio.
All right, welcome back. This is Mike D'Ambrosio and Laura Pesavento with the D'Ambrosio Real Estate team for Real Estate Radio Live, the podcast, and we're having a good time here on podcast. It's been a fun road getting to this point, and we are excited about podcasting going forward. If you have time, go on to iTunes or our website, RE Radio Live, and leave us a review and share. Make sure you share this with your friends, family, coworkers. We appreciate that. And also, reach out, Mike at reradiolive.com, Mike at reradiolive.com. You can text me, call me, 408-630-0101. And again, I appreciate you considering me as your trusted resource for anything and everything real estate. If you need anything real estate related, I can make those introductions. We have a full team ready to serve you here on the D'Ambrosio Real Estate team. So today we're talking about trends for 2017. It's weird to say 2017, but trends for 2017 and what we're going to see in the market, or what we predict we're going to see in the market. And I will be talking about that a little bit more in depth with Joe tomorrow on the show about mortgages and programs and real estate and inventory levels and all that. But I do want to touch on that here with Laura really quick on our show. And, the trend, obviously, in Santa Clara County and in the Silicon Valley, the heart of Silicon Valley is Santa Clara County. We have been seeing increased inventory levels over the past few years, which has been leading to more of a normal market, or I guess what we consider in California a normal market. And I do see that happening going into the new year, especially in one of our friends that works at a big developer. There's 9 large housing projects approved for downtown San Jose. And when I mean housing projects, we're talking high-density tower projects, 9 large-scale projects going into downtown, which is going to bring on, if all of them get built out, that is. They don't always get built. I would guess at least a third of those actually get built, so maybe 2 or 3 of them. Which is still a lot. We're talking about thousands of units on the market at one time, which is something we need, especially with the amount of jobs that are being created in Silicon Valley. So we will be seeing that over the coming years. So I think from an inventory standpoint, I think we'll be okay. It's still not going to be enough, but it's going to be okay.
When you say not enough, expand on that.
Okay, so not enough means in Silicon Valley, in the county that we live in, just to give you some perspective, in 2008 we had about 5,000 or 6,000 active units on the market. A lot of those obviously were REO, short sale, probably about 25 to 30% of the market was. So that was 5,000 to 6,000 units. Now in 2012-13, when the market was really at its peak, we were barely at about 1,000 active for sale units. So that just gives you the vast difference that there was. And now we're looking at about, in August, September of this year, we were at about 1,800. To be a normal, healthy market, you got to be somewhere in the 2,000 to 3,000 range in Santa Clara County. So I think we're getting close to that. It just depends on how quickly things get built out. One of the things that's going to help with that, and that's an article we shared with our sphere of influence recently, is the whole granny unit, secondary unit, accessory dwelling unit, whatever you want to call it. They're easing the restrictions on those in San Jose, which is the main city in Silicon Valley, which I believe is going to help with affordable housing, which is a major crisis in this area. So they're basically going to help ease the restrictions on building those for homeowners, less setbacks, less bureaucracy. If you have an illegal one built right now, they're going to work with you to help get it back to code without less penalty. So they're trying to really work with homeowners on making that easier, which I think is it's a win-win for everyone. It's a win-win for the inventory. It's a win-win for the rental market. It's a win-win for the homeowner that will be able to get secondary income off their property. It's a win-win for contractors that are going to get more business because of building these. I really don't see a lose scenario in this case, other than if they ease the restrictions too much, you're going to see these shanties going up in people's yards, but that's not going to happen. And that I'm, making a joke, but basically, I just think it's going to be good all around. It's going to be good.
No tough sheds, but
no tough sheds won't be considered.
Okay, so just checking. Shanties, yeah.
We're not going to have shanty towns in San Jose. So, anyways, a couple other things that we're going to see, trends we're going to see in 2017. We're already seeing it a lot, especially in Silicon Valley, but is the whole suburban urban lifestyle. We had many years of what's considered or what's called urban sprawl. If any of you out there have taken real estate classes or study real estate, urban sprawl is, these giant housing communities that are being built out in the middle of nowhere with not a lot of amenities around them, but they're just being built. A great example of that is the Sacramento area. A lot of urban sprawl out there, and that's why Sacramento got hit really hard during the downturn, because there was just so much inventory. So many of these big housing developments got built out in the middle of nowhere, and then they basically lost their ass on them, essentially, to say it bluntly. And I can say that now because I'm on podcast.
I was just going to say, did you just drop the A word?
So, now what we're seeing, and obviously it's what we have to see, especially in highly and densely populated areas like Silicon Valley, is these what you would consider, so I'm like the words falling out of my head right now, but like Santana Row, which is Planned Community Urban Village. Yep. Thank you, Urban Village. And Santana Row is by all definitions, one of the pinnacles of an urban village in the entire country. I mean, Santana Row's used in history books now. And we're seeing a lot more. There's a whole urban village planned for Silicon Valley, where they're going to put, what areas are targeted for them, where they're going to put them, and what they're going to make easier for landowners to build these urban villages.
Highest
and get them
and best
improved.
use, right?
Yeah, and that's what it is. And frankly, that's what a lot of these lifestyles people
are calling
want.
for.
That's
right.
what they want,
Yep.
and we're going to talk about that, millennials and even Generation Z, which maybe some of you haven't heard, and you're hearing it now for the first time on Real Estate Radio Live podcast. But that's what people are calling out for. They
Ease of like availability, right? Public transportation. They don't want to be dealing with a lot of stuff around their home. They don't want to be mowing their lawns.
They want places they can live, work, and play right outside of their.
Sounds like a bunch of lazy people to me. What about you?
Well, I think it sounds maybe not lazy, maybe busy, that don't have time to go do these other things.
Okay, that's a nicer way of putting it.
So I think it's that. I think that...
Well, things are changing, right? I mean, our American values, or at least Silicon Valley values, let's get more detailed here.
It's those damn millennials, I tell you.
Oh, man, I knew it was going there. But,
it's those damn millennials.
No one wants the pride of, household of lawns anymore.
No, they don't. They
want to travel and
So they want to, but they also want to walk where they can get groceries, entertainment, sports parks, dog parks, and have good schools. So they really want that whole lifestyle where, maybe they're not driving 15, 20 minutes all over the place.
This sounds kind of
in
strange.
Traffic, by the way. They want less places to drive in the traffic that we have here, which is it's one of the worst in the country is our traffic. We're not LA yet, but we're getting pretty close.
As an older woman, can I just say something really quick?
Oh, God.
It's funny that, we used to have this 30 years ago, 35 years ago, 40 years ago.
Yeah.
We had the corner markets. We had things that were close. We did things closer to our homes.
Yeah, but we got away from that.
Right.
With
what
urban
I'm saying.
sprawl.
Yeah, and then now we're kind of like coming back to it in a different sense, right? Where we have to build up instead of out. So we have, this is the next, new Silicon Valley, I guess.
Yeah. I mean, it is what it is. So to kind of transition into that whole lifestyle, a lot of this is being driven by, the main part of the workforce, which are millennials, which I expect a lot of them are going to be buying, and they already are buying their first homes in 2017, 2018, especially the ones that have paid down their student debt, because a lot of them have that, and maybe have built up their cash and be in a position to buy more houses. So I think that, and especially since a lot of them have been living with their parents the last couple of years and saving money, I would expect a lot of them to start buying more houses.
Well, if they are going to buy, they need to go to MikeDsells.com.
There you go.
Nobody knows a millennial like Mike D.
Nice cheap plug. So just with a couple more minutes left, the other generation that no one's probably talking about just yet is Generation Z, so the generation after millennials. And they don't always grab the headlines, but it won't be long before they do, because they're just teenagers right now, but they are almost on the cusp of being able to buy homes. A lot of them are reaching their 18th birthdays in 2017. And so over the next over the coming years, they're going to be a factor to deal with, in the next 5 to 7 years, especially because they have a different view on the world compared to the millennials. They didn't grow up in the midst of a recession, a war, a stock market collapse, a bad job market. So they're really coming to age with more of a positive spin on things, in my opinion. And they're also going to be coming of age as far as buying homes with lower interest rates, probably better job prospects, and higher wages. So I think that they're probably going to be in a good position going forward. So should be pretty interesting. If you want to hear any more on that, feel free to reach out. You can go to mike@reradiolive.com. You can email me there. You can go to my website, MikeDsells.com. If you're on social media, you can go to Facebook.com/MikeDRealEstate. Check out my page. And you can always call 408-630-0101. And for everything Real Estate Radio Live podcast, you can go to reradiolive.com. You can go to iTunes, download it, listen to it, love it. Love us. We love you.
Social media,
all that good stuff. Share it with friends, family.
please.
And give us a review. We appreciate you guys tuning in. Laura, thanks for coming on.
Thank you for having me.
And we'll see you soon. Take care.
Bye.
You've been listening to Real Estate Radio Live. For more information on today's program, visit reradiolive.com. That's reradiolive.com. Subscribe to our podcast. Discover more at reradiolive.com.